By the time the notice hit Omar's inbox, his business accounts were already frozen and his payment processor had paused every payout, turning a normal Tuesday into a shutdown order. The message was blunt. Enforcement hold in place, funds secured pending collection, respond immediately. A second attachment listed the total assessment in cold digits, $486,700. It cited automated analytics selection for a combined examination, payroll tax exposure, worker classification, cross-border reporting, and information return compliance. Omar ran a remote marketing studio that built subscription funnels for e-commerce brands, and he had always treated compliance as routine maintenance. He filed, he paid, he moved on. His team lived in Slack, his clients lived everywhere, and his revenue flowed through Stripe so smoothly it felt like plumbing. That morning the plumbing stopped. Clients were still paying, invoices were still being issued, but the money was trapped behind a lock he did not control. He refreshed his banking app, saw the red banner, then saw the same gray warning on Stripe, payouts paused. He called the bank, opened a support ticket, and tried to sound calm while his chest tightened. Within an hour, the first escalation arrived through his bookkeeper, who read the notice aloud with a tone that stripped away hope. The agency wanted 3 years of records. Not just income tax. Payroll tax deposits, contractor agreements, proof of independent status, reimbursements, expense support, a list of every person who did work for the company and how they were paid. Omar said, automatically, that they were contractors. The bookkeeper asked him one question that changed the air in the room. How many of them work almost entirely for you? Omar pictured his lead designer logging into his project board every day. He pictured his editor on weekly calls. He pictured the copywriter who followed internal deadlines like an employee. He had called them contractors because the industry called them contractors, because it kept overhead low, because it made scaling feel clean. The notice framed those same choices as misclassification risk, and misclassification was not an accounting adjustment. It was retroactive payroll taxes, failure to withhold penalties, interest, and, in the wrong narrative, personal liability exposure for the person in control. By midday, the second escalation came from the platform he relied on most. Stripe sent a formal compliance request tied to a government inquiry and risk controls. They wanted proof of operations, copies of tax registrations, and documentation for the foreign contractors receiving payments. Their language was polite, but the result was brutal. No satisfactory evidence, no access to funds. Omar realized this was structural, not temporary. The government had moved first, and the platform had sealed the exits. His dashboard still showed revenue arriving, but the usable cash in the middle was gone. He was running a profitable business on paper while his real ability to pay people dissolved. He hired a tax attorney that afternoon, and the attorney did not waste time on comfort. "This is not a routine audit," she said. "This is examination plus collection safeguards." The analytics selection, she explained, often starts with mismatches and patterns, high contractor spend with minimal payroll, cross-border payments, large deductions, and platform reporting that doesn't reconcile cleanly to filed returns. Omar had all of it. He had grown fast, paid mostly freelancers, and deducted heavily for software, travel, and contract labor. He had also begun serving clients in the EU and Australia without thinking about indirect tax rules, because he assumed services were simple. The attorney asked about VAT and GST. Omar said he billed businesses, so he didn't register. The attorney explained that missing registration or documentation can be framed as cross-border compliance failure that strengthens penalties. Over the next days, Omar built a response packet like someone trying to prove innocence to a machine. He pulled contracts, invoices, email threads, Slack logs, and project boards. He searched for proof that his contractors controlled their work, set their hours, used their own tools, served other clients. The truth was messier. The designer used Omar's systems, followed Omar's priorities, and joined internal meetings. The editor received weekly assignments, fixed hours during launches, and signed off under Omar's name. The copywriter invested a studio, but the amounts always matched the retainer Omar dictated, and her work product was integrated into every deliverable. The attorney warned him that labels would not matter. Control and dependence would. Then she said the sentence that landed like a verdict. If they reclassify even a few core people, they will calculate payroll taxes retroactively and assume you should have known. Stories like this don't come with warnings, and most people only understand the risk when it's already too late. The third escalation arrived as a deadline. 10 business days for an initial package, while the freeze starved him of operating cash. Omar tried to borrow. The bank declined because a lien filing had already been initiated. He tried to negotiate with Stripe. He received templated replies that thanked him for his patience. He tried to reassure his team and told them there was a temporary hold. He did not say frozen. Saying frozen felt like admitting death. Meanwhile, subscriptions kept charging, tools kept renewing, and contractor invoices kept arriving. With no access to business funds, Omar crossed into personal money. He used savings to cover payroll-like payments, telling himself it was just a bridge. That bridge tied his personal life to the compliance action, and he could feel the risk expand. At the midpoint, the collapse became visible to the outside world. A major client's finance team flagged his vendor profile as high risk after they saw a payout hold warning on a platform report. They demanded written assurance that his company was solvent and compliant. Omar offered vague language and a promise of resolution. The client terminated the contract the next morning. Another client asked why a subcontractor overseas was accessing their ad accounts, and whether it created data handling exposure. Omar's contractor paperwork was generic. His documentation was thin. The client paused payments pending review. In a week, Omar's predictable recurring revenue cracked. The freeze didn't just stop cash. It triggered distrust, and distrust is a multiplier. Every delayed deliverable created another question. Every question created another pause. He cut costs, canceled tools, reduced contractor hours. Each cut weakened delivery. Each weakened delivery produced more client concern. The business entered a loop where compliance pressure and operational damage fed each other. When the examiner finally called, the tone was calm, almost friendly, and that calm made it worse. The scope was confirmed: worker classification, payroll taxes, deduction substantiation, information reporting, and cross-border payment review. The examiner asked for a contractor list with locations, payment methods, and evidence of independent business activity. The examiner asked how Omar determined classification. Omar said contracts and invoices. The examiner asked for proof of autonomy. Omar started describing processes and realized his description sounded like supervision. The examiner asked about foreign contractors and whether Omar collected appropriate documentation. Omar said yes, but could not describe a consistent file. The examiner did not accuse him. The examiner noted gaps and then shifted to platform reporting. Stripe's information report showed gross inflows that did not align with Omar's declared receipts because Omar had netted fees and chargebacks differently and had no formal reconciliation schedule. The mismatch was not enormous, but the pattern was enough for the analytics model to treat it as underreporting risk. The examiner requested reconciliations he did not have. The fourth escalation arrived in writing: a preliminary determination. 3 core contractors were proposed for reclassification as employees for substantial portions of the period. The rationale was spelled out with citations: ongoing relationship, integration into business operations, control over work product, and economic dependence. The calculation stacked back payroll taxes with failure to withhold penalties and interest. A separate section disallowed part of Omar's deductions, including travel and certain marketing expenses that lacked proper documentation and looked like client entertainment. The attorney explained why it was stacked. More issues create more leverage, and payroll taxes create a pathway to responsible person exposure. Omar had formed an LLC for protection. The attorney told him, quietly, that payroll taxes can cut through structure when the government believes the person in control failed to withhold and remit. The word responsible stopped being abstract. Omar appealed, but the process moved slower than enforcement. The hold stayed. The attorney negotiated for partial release of funds for essential operating expenses, and the agency demanded a cash flow statement, a payment plan, and proof that released funds would not be moved beyond reach. Strike demanded the same, plus reserves for refunds. He needed access to money to survive long enough to produce the documentation that might unlock the money. He sold personal assets, emptied a retirement account, and borrowed from family with promises he could not date. Each transaction felt dangerous, as if one wrong move could be interpreted as evasion instead of desperation. Weeks later, the fifth escalation became final. The assessment was confirmed, and the attorney spoke the number again, this time in words, as if transforming digits into sound made it more real: 486,700 plus interest. The final letter included a page listing Omar by name as the person with authority over payroll and payments. It was not yet a personal assessment, but it was a warning that the agency believed he was the responsible party. Omar felt his identity narrow into a compliance role he never wanted. He stopped thinking like an entrepreneur and started thinking like a defendant trying to avoid one more mistake. The sixth escalation was human. Contractors began leaving, not out of cruelty, but out of math. Freelancers cannot wait on government timelines. The designer took a full-time job. The editor moved to another agency. The copywriter stopped responding. Each departure removed capacity to deliver, which increased client risk, which increased cancellations. New talent demanded deposits, and deposits were impossible while funds were locked. Omar's company became a shell that still had obligations, but fewer capabilities. The attorney called it operational insolvency. Omar experienced it as watching a structure collapse while he was still inside it, hearing every beam creak, knowing the next sound would be final. In the final third, the damage turned psychological, because the financial damage was already complete. Omar began to experience ordinary signals as threats. Unknown numbers felt like examiners. Envelopes felt like judgments. Banking notifications triggered nausea. He replayed old Slack messages and saw them as evidence of control. He reread meeting notes and heard supervision. He started speaking in cautious phrases to friends, as if casual honesty could become a liability. He avoided social plans because he felt marked, as if the lean was visible on his face. He stopped planning beyond a week, because longer horizons felt dishonest. When he slept, he dreamed in documents, stacks sliding across a desk, stamps striking page after page, the same words repeating: non-compliance, penalty, responsible. One night, he opened his laptop to finish a client report and watched his hands tremble over the keyboard. It wasn't the pressure of work. It was the learned fear that a system could erase him again without warning. He had believed that if you worked hard and paid what you owed, you would be left alone. He learned a colder truth. Modern enforcement often begins with data before any human conversation, and it moves through the infrastructure you rely on. It begins with ratios that look wrong, contractor spending that resembles payroll, cross-border payments that resemble risk, and platform reports that don't reconcile cleanly. Then it freezes your accounts and forces you to justify yourself, while the clock drains your business of oxygen. Omar eventually negotiated a reduced payment plan and limited releases. He dissolved the original entity, rebuilt under a payroll model for core staff, rewrote contractor processes, and registered properly for the jurisdictions his attorney identified. He did it as survival, not strategy. The clients he lost never returned. The confidence he lost in his own judgment did not return either. Even after the case moved into payment and monitoring, Omar carried the afterimage of the freeze. He checked accounts compulsively. He kept redundant documentation for everything. He paid for compliance reviews like insurance against panic. He avoided scaling because scale now looked like exposure. He watched other founders brag about all contractors and felt a quiet rage, not at them, but at his past self for believing it was harmless. He learned to speak about risk without drama because drama was unnecessary. The facts were enough. A business can be profitable and still collapse when compliance is treated as optional. A platform can lock your cash before you have a chance to explain. An agency can treat your legal structure as irrelevant if the substance suggests control and dependence. And once your business becomes a case file, you negotiate from whatever is left after the system has taken its hold. For more stories like this, subscribe to Tax Nightmares, so you don't miss the next episode or the continuation of this story.